Welcome to this deep dive.
Oh, yeah.
We're going to be exploring the fascinating world of behavioral finance.
Right.
We're going to be unpacking Morgan Housel's The Psychology of Money.
Okay.
It's a book that uses stories and real-world examples to show how our psychology
Yeah.
can really impact our financial decisions,
Yeah.
sometimes even more than we realize.
Right. Right. And I think what's so interesting about Housel's approach is how he emphasizes the soft skills of finance.
Yeah.
You know, those often overlooked aspects like emotions and biases and
Yeah.
personal experiences.
Oh, yeah.
These things can actually have a more profound impact on our financial well-being than just knowing
Yeah.
numbers and formulas.
Absolutely. And one of the first things Housel dives into is the power of our personal histories
Yeah.
in shaping how we think about money.
Right.
He uses a really interesting anecdote about John F. Kennedy to illustrate this.
Oh, yeah.
Did you know that JFK, despite growing up in one of the wealthiest families in the world, had no firsthand experience of the Great Depression?
That's right.
Mm.
In fact, he once said he didn't really grasp the realities of the Depression until he was studying at Harvard.
Wow.
His family's wealth essentially insulated him from its effects.
Okay.
It's pretty remarkable to think that someone who would become president during a critical economic period
Yeah.
had such a different perspective on finance simply because of their upbringing.
It really highlights how our early experiences, or lack thereof, can create blind spots in our understanding of money.
Right.
Think about how someone who grew up with high inflation might view bonds differently than someone who experienced a booming stock market in their youth.
Right.
What seems risky to one person might feel like a safe bet to another.
Precisely. And this is why Housel stresses the importance of understanding and respecting those diverse perspectives. He shares another example about Bill Gross, the renowned bond investor.
Okay.
Gross saw bonds as wealth-generating machines, a viewpoint shaped by his father's generation who,
having lived through high inflation, viewed bonds as risky.
it makes you realize that what might seem irrational to one person could make perfect sense to another,
Yeah.
given their unique financial background.
Yeah.
So how do we avoid letting our past experiences completely dictate our financial decisions?
Well, that's where self-awareness comes in.
Okay.
Recognizing that our personal history can create both opportunities and limitations is crucial.
Yeah.
It's like understanding that you might have a natural bias towards certain investment strategies based on your upbringing. Being aware of those biases allows you to make more objective decisions.
That makes a lot of sense.
Right.
It's almost like you need to deconstruct your own financial worldview
Yeah.
before you can build a truly sound strategy.
Yeah.
Speaking of strategy, Housel then delves into the often underestimated roles of luck and risk in financial success. He uses the contrasting stories of Bill Gates and his equally brilliant friend Ken Evans. Right. And these stories really highlight the interplay of skill opportunity and just plain luck.
Yeah.
Gates attends Lakeside School, one of only a few hundred students in the country at the time, with access to a computer.
Wow.
This chance encounter, along with his undeniable talent, played a pivotal role in his journey to founding Microsoft.
Wow.
Evans unfortunately died young, demonstrating how unforeseen circumstances can derail even the most promising trajectories.
It's a powerful reminder that life is full of unexpected twists and turns.
Right.
It's easy to look at successful people and attribute their achievements solely to skill, but we often overlook the role of chance encounters and fortunate timing.
And on the flip side, it's tempting to blame our failures entirely on poor decisions.
Yeah.
Which can be pretty demoralizing.
Yeah.
Housel's point is not to dismiss personal responsibility, but to acknowledge the complex interplay of factors that contribute to both success and failure in finance.
I think this is a really valuable insight, especially in a culture that tends to idolize individual achievement and downplay the role of circumstance. Recognizing that luck plays a part can help us be more compassionate, both towards ourselves and others.
Absolutely.
Yeah.
It's about finding that balance between taking ownership of our decisions while also acknowledging that we don't have complete control over every outcome.
Okay.
This leads us to another fascinating aspect of the psychology of money, the challenge of defining enough.
Oh, yes. This is where the story of Rajat Gupta really gets you thinking.
Right.
Here's a guy who achieved a level of success that most people only dream of, and yet it was never enough.
Right.
He ended up risking it all through insider trading, ultimately losing his reputation and freedom.
Gupta's story is a classic example of what psychologists call the hedonic treadmill.
Okay.
Essentially, our brains adapt to new levels of wealth and status, which can lead to a never-ending pursuit of more.
Okay.
It's like chasing a moving target. You might reach your initial goals, but then you quickly set new, even higher ones.
It's almost like our desires expand as our wealth grows.
Right.
You'd think that at some point people would feel content and secure.
Yeah.
But often it's the opposite.
Right.
The more they have, the more they want.
Yeah.
So how do we break free from this cycle?
Well, that's where the concept of defining enough comes in.
Okay.
It's about consciously choosing a point where you feel financially secure and satisfied, regardless of what others are doing or achieving. And this is easier said than done.
Oh, yeah.
Especially in a world where we're constantly bombarded with images of wealth and extravagance.
It's true. Social media definitely doesn't help.
Right.
We're constantly comparing ourselves to others.
Yeah.
And it's easy to feel like we're falling behind.
Husel makes this point really vividly when he talks about professional athletes.
Okay.
Imagine you're a rookie baseball player making $500,000 a year.
Wow.
You might feel incredibly rich, right?
Yeah.
But if you're playing alongside someone making a multi-million-dollar contract, suddenly you feel broke. That's the insidious nature of social comparison.
Yeah.
It can distort our perception of what we actually need to be happy and financially secure.
Right.
And it's a trap that can lead to poor financial decisions. We might take on more risk than we can handle or overspend trying to keep up with the Joneses.
Yeah.
All in pursuit of a feeling that might never come.
So how do we cultivate a sense of contentment and avoid falling into this trap?
Right.
Is it as simple as just being grateful for what we have?
Gratitude definitely plays a role, but it's also about shifting our focus from external validation to internal fulfillment.
Okay.
What are your values?
Yeah.
What truly brings you joy and meaning?
Yeah.
When you align your financial goals with those deeper aspirations, it becomes easier to resist the allure of chasing fleeting markers of success.
That's a really powerful idea.
Yeah.
It's about defining success on your own terms rather than letting society dictate what you should be striving for. I think that's a great segue into the next big concept. Husel explores the incredible power of compounding.
Yeah. You know, when it comes to building wealth, compounding really is like a superpower. It's this incredible force that allows your money to grow exponentially over time.
Yeah.
To really illustrate its impact, Husel uses a brilliant thought experiment about Warren Buffett.
Oh, right. The one where Buffett doesn't start investing until his 30s?
Exactly.
I remember that being mind-blowing. It wasn't like 99% less wealth?
Exactly. If Buffett had followed the exact same investment strategy but started later in life, his net worth today would be a staggering 99.9% less.
Wow.
That's the difference a few decades of compounding can make.
It really puts into perspective how crucial time is when it comes to investing. It's not just about finding those high-return investments. It's about getting started early.
Right.
And letting those returns compound year after year.
Yeah.
So tell me more about how this compounding thing actually works.
Sure. At its core, compounding is the concept of earning returns on your initial investment, and then earning returns on those returns and so on.
Okay.
Imagine you invest $100 and earn a 10% return, giving you $110.
Okay.
The next year, you're earning 10% not on the original $100, but on the $110.
Okay.
Over time, these seemingly small gains snowball into significant wealth.
Wow, that's fascinating.
Okay.
So even if the returns themselves aren't huge,
Right.
it's that snowball effect over time that really makes the difference.
Precisely. This is why starting early, even with small amounts, can have a much bigger impact in the long run than trying to time the market or chase those elusive high returns later on.
Right.
Husel even compares Buffett's returns to those of Jim Simons, who founded the hedge fund Renaissance Technologies.
I remember reading about Simons.
Yeah.
His returns are incredible, right?
Absolutely. He's achieved an average annual return of 66%.
Wow.
Which is far beyond what Buffett has achieved.
So why isn't Simons richer than Buffett if his returns are so much higher?
The key differentiator is time.
All right.
Buffett has been investing consistently for over 70 years, allowing those returns to compound over decades.
Wow.
If Simons had maintained those stellar returns for the same duration,
Yeah.
well, we'd be talking about a net worth in the quintillions.
Oh my gosh.
It's an astronomical number that really drives home the power of long-term compounding.
It's almost hard to wrap your head around, isn't it?
Yeah.
This exponential growth thing is pretty powerful stuff.
It really is. And what's interesting is that we often underestimate the power of exponential growth.
Okay.
Because it's not always intuitive. Husel uses the example of hard drive storage capacity to illustrate this point.
Okay. I'm intrigued. How do hard drives relate to investing?
Well, from 1950 to 1990, hard drive storage capacity grew at a relatively slow pace.
Okay.
But then from 1990 to today, it absolutely exploded,
Oh, wow.
going from megabytes to terabytes.
Wow.
It's similar to those last few squares on a chessboard when you're doubling the grains of rice with each square. It seems slow at first and suddenly, boom.
That's a great analogy.
Yeah.
It makes it much easier to visualize.
Yeah.
So how does this apply to our financial decisions?
It highlights why patience and consistency are key.
Okay.
When it comes to compounding, the real magic happens in those later years when the growth really accelerates. This is why it's so important to resist the urge to constantly tinker with your investments or chase short-term gains.
But that can be really hard, especially when you see the market going up and down every day. It's tempting to try and time it perfectly or jump on the latest hot stock.
Absolutely, but that's where understanding the psychology of money comes in.
Right.
It's about recognizing that our brains are wired for instant gratification, while compounding is a long game.
So how do we reconcile that? How do we stay disciplined when our instincts are telling us to go for the quick win?
Well, one key is to focus on what you can control.
Okay.
You can't control the market, but you can control your savings rate. Your investment choices and your emotional responses to market fluctuations, it's about having a plan and sticking to it, even when things get a bit bumpy.
That makes a lot of sense. It's almost like we need to train our brains to think long-term.
Right.
And resist those impulsive urges.
Exactly. And that brings us to another important concept Husel discusses, the idea of being reasonable rather than rational when it comes to financial decisions.
Okay, I'm curious. What's the difference between being reasonable and being rational?
Okay.
Aren't they the same thing?
In theory, they might seem similar, but Husel makes a distinction.
Okay.
Being purely rational means making decisions based solely on logic and maximizing potential returns, regardless of the emotional cost.
Yeah.
Being reasonable, on the other hand, recognizes that we're emotional beings.
Right.
And those emotions can play a huge role in how we manage our money.
So it's about finding that balance between maximizing gains and maintaining our emotional well-being.
Exactly. Husel illustrates this with the story of Julius Wagner-Jauregg, a doctor who won a Nobel Prize for treating syphilis by inducing fevers in his patients.
Wait, really?
Yeah.
Inducing fevers?
Yeah.
That sounds a bit counterintuitive.
It does, doesn't it?
Yeah.
But Wagner-Jauregg recognized that while fevers are uncomfortable, they actually play a role in fighting infections. However, most people, including doctors at the time, just saw fevers as something to be suppressed at all costs.
Yeah.
They were focused on the short-term discomfort rather than the long-term benefit.
Okay, I see where you're going with this. So how does this fever analogy apply to investing?
Well, think of market volatility as a kind of fever.
Okay.
It's uncomfortable to experience, and it can make us want to pull back or make impulsive decisions. But just like enduring a fever can be beneficial in the long run, withstanding market fluctuations can lead to greater long-term returns.
So it's about accepting that there will be ups and downs, but not letting those short-term swings derail our long-term goals.
Precisely. And this might mean choosing investment strategies that are psychologically sustainable for you.
Right.
Even if they don't offer the absolute highest potential returns. For example, a highly leveraged portfolio might seem appealing on paper, but it can be incredibly stressful to manage during market downturns.
It's like choosing the scenic route over the highway. You might get there a bit slower, but the journey is less stressful and more enjoyable.
That's a great way to put it. It's about finding that balance between optimizing for returns and optimizing for peace of mind.
That makes a lot of sense. I think a lot of people get so caught up in maximizing gains that they forget about the emotional toll that constant stress and worry can take.
It's true. And this brings us to another fascinating aspect of the psychology of money, the seductive power of narratives.
Okay, I'm all ears.
Yeah.
What's so seductive about narratives?
Well, Husel argues that our understanding of the economy and financial markets is heavily influenced by the stories we tell ourselves. He uses a thought-provoking thought experiment to illustrate this.
Okay.
Imagine an alien visiting Earth in 2007 when the economy was booming.
Okay.
Then it returns in 2009 amidst the financial crisis.
Okay, I'm picturing this alien scratching its head in confusion.
Exactly.
Yeah.
It sees the same physical infrastructure, the same workforce.
Yeah.
But suddenly everyone is poorer and more pessimistic.
Yeah.
What changed?
It wasn't the fundamentals of the economy, that's for sure.
Yeah.
It was the sentiment, the overall mood.
You got it. The stories we were telling ourselves shifted dramatically.
Right.
In 2007, it was a narrative of endless growth and prosperity.
Right.
By 2009, that narrative had shattered, replaced by fear and uncertainty. And the shift in sentiment, regardless of the underlying economic reality, had a real and devastating impact on people's lives and financial decisions.
It's incredible how much power those stories hold, isn't it?
Yeah.
It's like we need to make sense of the world,
Right.
even if it means creating narratives that might not be entirely accurate.
It's a natural human tendency to seek explanations for complex events.
Yeah.
And a compelling narrative can easily fill in the gaps in our understanding.
Right.
But this can also lead to some dangerous biases in our financial decision-making.
Oh, like what?
Well, for example, confirmation bias, which is our tendency to seek out information that confirms our existing beliefs, can lead us to double down on losing investments or ignore warning signs because they don't fit the narrative we've created in our minds.
So we end up clinging to a story even when the evidence is telling us otherwise.
Yeah.
It seems like self-awareness is key here too, wouldn't you say?
Absolutely. Being aware of these biases and understanding how narratives can influence our decisions is crucial for making sound financial choices. And this leads us to another interesting concept Husel explores, learning from Las Vegas, specifically from blackjack card counters.
Okay, now this I have to hear. What can investors learn from card counters in Vegas?
What's fascinating about card counters is that despite their skill and ability to tilt the odds in their favor, they always operate with a margin of safety.
A margin of safety. What exactly does that mean?
It basically means having a buffer, a cushion, to protect yourself from unexpected events.
Okay.
Card counters understand that even with a statistical advantage, they can still lose. So they manage their bets accordingly, never risking more than they can afford to lose.
So it's about acknowledging that there's always a chance you could be wrong, no matter how confident you are in your analysis.
Precisely. And this is a crucial lesson for investors as well.
Okay.
No matter how much research you do or how carefully you craft your strategy, there's always a chance that things won't go as planned. Having a margin of safety, whether it's through diversified investments, a healthy emergency fund, or avoiding excessive leverage, can help you weather those unexpected storms and stay in the game for the long haul.
That makes a lot of sense. It's like having a backup parachute when you go skydiving.
Yeah.
You hope you never need it, but it sure is nice to have it there just in case. That margin of safety idea really resonates with me.
Yeah.
It seems like it ties into this concept Husel calls the tyranny of the short term.
Yeah.
He argues that in investing, those rare and unpredictable moments often have the biggest impact. It's like what you do during a market crash matters way more than your everyday stock picks.
Yeah, that's exactly why he says. A good definition of an investing genius is the man or woman who can do the average thing when all those around them are going crazy.
Wow.
It's all about having the discipline to stick to your plan, even when emotions are running high and everyone else is panicking.
Which, let's be honest, can be incredibly hard.
Oh, yeah.
Especially when you see your portfolio dropping and all the news headlines are screaming about a looming recession.
Right.
How do we stay calm and rational in those moments?
Well, one key is to zoom out and focus on the long-term picture.
Okay.
Remember that market fluctuations are normal.
Yeah.
And they don't always reflect the underlying value of your investments.
Okay.
It's also helpful to have a written investment plan that outlines your goals, your risk tolerance, and your strategy. Having that plan in place can act as a kind of anchor when the seas get rough.
It's like having a map and compass when you're navigating through a dense forest. You might encounter some obstacles along the way, but as long as you keep your bearings and stick to your route, you'll eventually reach your destination.
That's a great analogy. And speaking of navigating a complex landscape, Husel also talks about how success in many areas of life is heavily skewed.
Okay.
For example, a handful of companies drive the majority of returns in the stock market, or a small percentage of employees generate most of a company's profits.
I think he calls this the tails drive everything concept, right?
Exactly. And this means we need to get comfortable with the idea that most things will fail.
Right.
And that's perfectly normal.
Yeah.
Even the best investors are wrong a lot of the time. It's those few big wins, those outliers in the tail of the distribution that really drive overall success.
So it's not about being right all the time.
Right.
It's about positioning yourself to benefit from those occasional but significant wins.
That's the idea. Husel uses the example of art dealers to illustrate this point.
Okay.
The most successful art dealers didn't try to pick out individual masterpieces.
Right.
Instead, they bought entire collections,
Yeah.
knowing that most pieces would be worthless, but a few would be incredibly valuable.
It's like they're playing a probability game.
Right.
They're spreading their bets across a wide range of assets, understanding that some will inevitably fail,
Yeah.
but a few will hit it big and make up for the losses.
Precisely. It's a portfolio approach.
Hmm.
And it's a powerful mental model for thinking about investing and risk.
Mm-hmm.
Don't get hung up on individual wins or losses.
Okay.
Focus on the overall performance of your portfolio over the long term.
And this ties into another thought-provoking question Husel asks.
Yeah.
What's the return on saving money?
You're right.
It's not as simple as just looking at the interest rate on your savings account, is it?
Right, because savings provide something much more valuable. Options and flexibility.
Hmm.
Having a financial cushion gives you the freedom to change careers, start a business, or even retire early.
Yeah.
You're not beholden to a paycheck or a boss.
It's about buying back your time and controlling your own destiny,
Right.
which are huge contributors to happiness and well-being.
Absolutely. And this connects to Housel's point about how we often confuse rich with wealthy.
Okay.
Rich is about current income,
Yeah.
while wealthy is about building assets that give you long-term financial security and freedom.
He uses the example of Rihanna,
Right.
who almost went bankrupt
Right.
despite being a hugely successful artist.
Yeah, it really highlights the importance of not just earning money,
Yeah.
but managing it wisely and avoiding the trap of lifestyle inflation.
It's a classic case of someone who looked rich but wasn't necessarily wealthy.
Right.
Her story is a reminder that financial security is not just about how much you make, but about how much you keep and how you manage those resources.
And it leads to one of Housel's most impactful pieces of advice.
Okay.
Manage your money in a way that helps you sleep at night.
It's such a simple yet profound statement.
Yeah.
It really gets at the heart of what it means to be financially secure.
Right.
It's about finding that sweet spot between maximizing returns and minimizing anxiety.
And that might mean accepting slightly lower returns in exchange for greater peace of mind,
Yeah.
or building a portfolio that aligns with your values and risk tolerance, even if it's not the absolute most optimal from a purely mathematical perspective.
Exactly. It's about recognizing that personal finance is personal.
Yeah.
There's no one-size-fits-all approach.
Right.
What works for one person might be a disaster for another.
Right.
It's about understanding your own needs, goals, and emotional responses to money.
And it's about challenging this idea that we should strive to be perfectly rational in our financial decisions.
Yeah.
We're humans, not robots.
Right.
Emotions are going to play a role, and that's okay.
I completely agree. Husel argues that it's more important to be reasonable than rational.
Yeah.
That means acknowledging our emotions, understanding our biases, and making decisions that we can stick with over the long term,
Right.
even when things get tough.
He uses the example of how many people hate the idea of losing money,
Yeah.
even if it's just a temporary paper loss.
Right.
But if we reframe volatility as a fee
Yeah.
that we pay for the potential of higher returns, it becomes a little less scary.
It's like paying an entrance fee to Disneyland.
Uh-huh.
You know, there will be ups and downs, long lines, and maybe even some rain.
Yeah.
But the overall experience is still worth the price of admission.
That's such a great way to think about it.
Yeah.
It's about focusing on the big picture and not getting too caught up in the day-to-day fluctuations.
And it reminds me of another point Husel makes about how investors often make the mistake of comparing themselves to others
Right.
who are playing a different game.
Yes, a hedge fund manager with a short-term horizon has very different goals and risk tolerance
Right.
than someone saving for retirement decades from now.
Yeah.
Yet we often get caught up in comparing our returns to those of people who are operating under completely different constraints,
Yeah.
like comparing apples to oranges.
It's a recipe for frustration and potentially bad decision-making.
Right.
We need to focus on our own lane and run our own race.
Exactly. And that brings us to one of Housel's most important points.
Okay.
No one is crazy.
Hmm.
Everyone makes financial decisions based on their own unique experiences, beliefs, and circumstances.
Yeah.
What might seem irrational to one person
Right.
could make perfect sense to another.
It's a call for empathy and understanding in our financial conversations.
Yeah.
Recognizing that there's no one-size-fits-all approach to managing money.
Couldn't have said it better myself.
Well, we covered a lot of ground today.
We did.
What are some of the key takeaways that really resonated with you?
For me, it's the importance of long-term thinking. Whether it's compounding returns, building a margin of safety, or managing our emotions, the decisions we make today can have a ripple effect that lasts for decades.
Yeah.
We also need to be mindful of those psychological traps, those biases and narratives that can cloud our judgment and lead to poor decisions.
Absolutely. It's so easy to get caught up in the day-to-day noise of the market or chase the latest hot investment.
Yeah.
But Husel's book is a powerful reminder that slow, steady, and disciplined wins the race when it comes to building lasting wealth and financial security.
So knowing that your financial priorities might change over time, what steps can you take today to create flexibility and minimize potential regret down the road? Right.
That's something to ponder as you continue on your financial journey.
And if you're interested in diving deeper into the world of behavioral finance, we have a ton of resources and recommendations on our website.
Oh, great.
Be sure to check those out. Until next time, keep exploring, keep learning.
Yeah.
And remember, long-term thinking is key.